Hey everyone, Douglas here, and welcome back to the MMT Macro Trader. In this market recap, it's Tuesday, August 29th, 2023. All right, let's see. Markets, an incredible day today. Very, very strong rally back to that 4,500 range in the S&P. Kind of thought that would likely be the kind of the bounce back number that we would hit, the counter trend number that we would hit, and would likely turn into a bit of a ceiling here. Yeah, you know what, how about this? I'm going to give my thoughts a little bit more in terms of where we're going to go in the short run tomorrow night during the live stream. So make sure and tune in to the live stream. So if you're watching this on Tuesday or Wednesday morning, the live stream will start at 8 p.m. Eastern time on Wednesday night. I'll give more thoughts there. The TLDR is going to be, I'm not exactly buying this rally here. I think there are some rough times for markets, but we'll discuss that later. But what I do want to, by later I mean during the live stream, but what I do want to discuss is M2 money supply, which has been collapsing really since 2022, mid-2022. We've seen a contraction in M2 money supply like we've effectively never seen before. If you look at that in terms of rate of change, year-over-year rate of change, this is certainly the deepest that we've contracted in money supply. I think if Twitter is to be believed, going all the way back to the Great Depression, and every time we've had this sort of contraction in money supply, we have a terrible depression. Those are the headlines that I'm reading with money supply. Of course, the question is that what's going to play out this time? And at this point, we've been contracting for quite some time. What have the market gurus, the macro gurus missed? What don't they understand, and why haven't we seen a massive depression at this point? Well, we continue to see M2 contracting. That's what we're going to be talking about tonight. Is this a worry, or is there something else that the vast majority of people are missing because they don't understand MMT and they don't know how to apply MMT? Hint, it's going to be the latter. With that being said, make sure you get subscribed. If you are new here, hit that notification bell so you won't miss any updates. And then if you find this update particularly helpful, give it a thumbs up. Or if you don't like it at all, give it a thumbs down. Whatever. The engagement helps the algorithm no matter what. So, yeah, tell me your feelings in the comments below as well. Anyway, let's go ahead and get into the nitty-gritty here. What is M2? M2 is effectively M2 is deposits. So I pulled up here deposits, all commercial banks, M2 overlaid. And what you're going to see, I'll switch over to the actual levels in just a second, but at least in terms of rate of change, you can see that deposits as they grow and they contract affects M2, and it's a pretty darn strong straight relationship. Obviously, M2 also has M1, currency in circulation, but for the most part, M2 is deposits. I'm going to pull up the actual levels here. So currently deposits are at right around 17 trillion, and then M2 is at 20. Yeah, deposits is really what the driver is of M2. Now, what does MMT and effectively the entire heterodox school of economics tell us about deposits then, right? What can we glean? What can we glean about M2 from understanding that M2 is effectively deposits? And that's the main driver of M2, is that loans create deposits. So M2 then is effectively what is a loan that has been created that has not been paid back in aggregate. That is what M2 is primarily. That is what M2 is measuring. If we had a fully endogenous money system, if we had no government sector, then M2 would actually kind of tell us something important. But there is another sector that has to be inputted into the dynamic here. When you look at M2, you're looking at one dimension. And in fact, you're even looking at less than one dimension. There's a reason that you're not going to see a lot of MMT type, heterodox type talk about M2 as money supply, because it really gives a very slim picture, very slim definition, a very kind of elementary, not even elementary, just an incomplete understanding of what money supply is. And certainly when it gets to money supply being some sort of causal factor, it's a terrible definition. M2 is the stock. What you're looking for, if you're looking to determine some sort of causal effect of the money supply, you're looking for flow. M2 is not going to tell you that. Even rate of change of M2 is still leaving out quite a lot. What is left out is government spending. One of the reasons M2 can contract is if the deposits that are in banks are being used to buy things like government securities, right? That is one way to destroy deposits. You can or destroy deposits, at least as they are counted in M2. I believe if you pay taxes in the short run and there's no new immediate spending, that too would push M2 down. Okay, so there are ways for M2 to get decreased, but one of the most pressing is if you use those deposits to purchase securities, particularly government securities as you're issued from the Treasury. That is, again, a way to get it done. So with that in mind, one of the things we need to then do is figure out, okay, well, how much is the government spending? If the government is spending and they need to monetize that debt by issuing government securities to government treasuries, then maybe a contraction of M2, while government spending is taking off, maybe that offsets the negative effects of a contracting M2. Hopefully you can see where I'm leading you, because we're going to go ahead and look at that data. I'm going to go ahead and pull up this chart right here. In red is the real or CPI adjusted net deficit. So red is government spending. Higher, that is more flows heading to the private sector. Lower, that means we're removing or diminishing those flows. And then the green line is M2, the rate of change of M2. I've overlaid those, and what we want to look at is how these two interplay with each other. Let's zoom back to 1990 here and notice that after the early 80s and kind of the late 70s into the early 80s recession, ultimately they ended off with in I think it was 81, 82, we saw a massive fiscal surge, and that fiscal surge gave way as the M2 also gave way. And it wasn't until the late 80s when we saw a contraction in both M2 money supply and government spending in real terms that we finally clicked, and we had a tight enough condition, right? The flows were not ample enough to continue the business cycle, and we saw a recession take place. We then got the countercyclical spending to kick in from the government side. We see flows kick up into the 90s. One of the things this is also going to do, and you'll see this take place in the 2000s after the dot-com bubble and the great financial crisis, one of the things that happens when the government spends is obviously that's just a direct input into the financial sector, into the private sector, right? That is just money for people to do something with. One of the things that does is that's an increased income for now the private sector that also kind of inadvertently capitalizes the banking sector as well. One, the inadvertent part is because now there's just a higher income for borrowers, and that is the primary determination for banks when they're going to make a loan is their income, so they're able to start that up. The other thing is now that income that is now private sector savings is able to be used to buy government securities. When that happens, that continues to compress M2, and we see that play out. M2 compressing, contracting into the late 90s, and then eventually the dot-com bubble happens. You get an expansion of that endogenous money cycle that carries the show for a while into what will ultimately be the dot-com bubble, and then we start to see that contraction head into the dot-com bubble. And we see late 90s. Ultimately, we see the dot-com bubble burst, and then the process repeats. We see a massive surge in fiscal spending before the great financial crisis. It contracts. We see relatively anemic M2. M2 doesn't tell the entire banking picture, but the pattern is there. There's more variables here than just M2. But again, it's the fiscal side contracting, and then you're going to see the big contraction of ultimately the economy, and that's when the great financial crisis happens. We see the big fiscal response following the great financial crisis, and again we see a collapse in M2 because that massive influx of fiscal spending is now used to buy government securities. It's going off the books, in terms of, especially in rate of change terms. And so we see a contraction in M2, which is really kind of that healthy contraction. Why? Because there's now more space on the balance sheets of the banks. And even more importantly, post-2008 with the Fed paying interest on reserves, the banks now, as they shed those deposits, have an even better balance sheet position, right? Because if you think about it, if their equity position remains the same and a depositor is now removing those deposits to buy something like a government security, relative to their overall assets, their capital ratios are better now. So again, indirectly, the private sector has more income. Directly, the capital structure of the bank is now better. So you can really say that the massive government spending capitalizes the banking system and allows the next cycle to run out. And of course, we've seen that last cycle play out for about the last 15 years. We saw COVID hit, which was not a business cycle recession, but we still saw a massive amount of spending. So now if we zoom on into the here and now, and we look at what's taken place, let's think this through. So we had the massive increase, both the fiscal and in the banking side, around at least M2, big shot higher into 2021 in terms of rate of change, and then we started to fall off. But still, overall, heading into mid or really kind of early 2022, we still saw growth from the fiscal side, although the growth was starting to slow down. And it wasn't until March of 2022 where the big tax strain came in April, to really contract things, did we see in real terms deficit spending actually go into a surplus. So we saw a contraction, and that's when M2 mattered, right? So we saw a double whammy. We saw M2 continue to contract, and we saw government spending continue to contract. And that is when we saw kind of near recessionary environment. In fact, as I mentioned in prior videos, had the Fed not raise interest rates, essentially giving the necessary fuel for government spending to lift back off in the manner that it has after the sell-off in 2022, we would be in a recession at this point, right? So we were able to kind of skip the recession. We are recapitalizing, and that's why since effectively, we'll call it kind of December of last year, even though we've reaccelerated, that's why we continue to see M2 in a kind of a contracting position year over year, and why it hasn't affected anything. It's very similar to what we saw after the Great Financial Crisis, where the contraction happened after the crisis in a year-over-year basis for M2. So the answer is, in terms of M2 and why it really tells a one-dimensional story, is it's missing the most important part. It's missing the fiscal flow. It's missing the fiscal side, and really it's the reason you're not going to hear any MMTers, especially those who are applying MMT from a finance side, reference M2 as anything useful, because it's really just not telling the whole picture. It's not terribly predictive. It's not going to tell you what's going to happen into the future. So look, if your macro guru is screaming M2, this is bad, they've just got it wrong. It's plain and simple. They've got it wrong. They don't understand the monetary system. They don't understand MMT. They don't understand sectoral balances. And if you don't understand this stuff, you're going to get this stuff wrong. You're going to look at M2 and you're going to think, the sky is falling. It's not. It's fine. You got to look at the fiscal side. Now, the fiscal side might give way. We'll talk about that. In the live stream tomorrow. Make sure you check it out. Maybe the fiscal side is going to give way. We'll see. And if it does, we might be in a brittle spot. We'll have to see if that plays out or not. But for now, fiscal has remained strong. That's why M2 hasn't caused any damage to this point, because it's effectively one-dimensional. So that is what I have for tonight. If you like what I'm doing here, make sure you check us out over at the Patreon page, patreon.com/MMT Macro Traders, where you can get that multiple updates each week. All the data that you ever see, that's all there. Updates just like this with even more detail before it all happens. We're kicking butt over there, taking names, and we've really got a grip on this market. So again, if you're an active trader, active investor, patreon.com/MMT Macro Trader for multiple updates each week. With that being said, once again, if you like what I'm doing here, hit subscribe, thumbs up button, turn the notification bell on, all that good stuff. Until next time, good trading, everyone, and we'll talk to you then. Bye-bye.